Well, stocks couldn't hold on to their early morning games, and this is becoming a far too familiar story that keeps playing out. Selling picked up as the day went on, and the S&P 500 was unable to hold onto the psychological level of 4,200 and even closed below it. Even the Nasdaq broke below its own key level of support. Now, I also have a deep dive on a value stock that's holding up really well in our current environment. So, welcome back, investors, to Ticker Time News. I am Adam, and this is the After Hours live stream, and it's for you. So if you have a question, leave your ticker symbol and your question in the comments, and we'll go over it live during the show. Yes, live for you. All right. So I have a market overview that I want to get into, and then I want to go in deep on a very particular value stock for you. So I hope you enjoy it. I hope you find it useful, valuable, and most importantly, I hope you find this content to be actionable. All right, let's get right into it while you get your questions ready. Now, major U.S. stock indices closed lower today, failing to hold early gains as investors weighed on continued volatility and commodity prices amid security negotiations between Russia and Ukraine. And do we really think that the delegations from Russia are going to be telling the truth? I don't know, but we have to watch and see. Now, the Dow erased a 450-point gain, while the S&P 500 slipped 0.7%, and the Nasdaq, poor old tech stocks, they fell 2%, breaking a very key level on the NDX is the ticker symbol for the Nasdaq on TradingView. There is a link in the description for a free account to TradingView. Now, this key level, if we go back here looking at the chart, back on February the 24th, that's where the Nasdaq hit a low of 13,065. 13,065. And that was also the day that after hitting this very low point, we had a massive rally on the same day, basically going to the moon, and that was a magnificent trade. However, today, remember I said 13,065. Well, we're at 13,046 right now. So we broke that low on February the 24th to close lower today, and that is not a good sign. If we are making lower lows, that means we're in a downtrend. And if we go all the way back up here to December the 28th, this was the last time that the Nasdaq had a high of 16,607. And we're down to 13,000, almost breaking into 12,000. That's a big drop, nearly a 20% drop for the Nasdaq. That would be considered a technical bear market, dropping 20%. So if we look at that and we look at the lows as we're going down, we're making lower lows, lower lows, lower lows constantly. And let me just emphasize this here. So if we start at that high, we're making these lower lows all the way down, right? And this was that next lower low here. And then we cut over to February the 24th, another lower low. And today, it's just ever so slightly, but it is another lower low. And if we continue to see this, then how far could we fall? That's the big question that's being asked right now, is how far could this correction go, and could it turn into a bear market? Well, remember this, that in bear markets, that's where investors are made. And that's when it's your opportunity to stack up on your favorite companies that are profitable, that have a high cash flow, and have obviously suffered a valuation correction. And that's your time to accumulate your favorite names. And you should have a shopping list together right now, because we don't know when this market's going to turn around. The 16th, this week on Wednesday, Federal Chair Jerome Powell, he has his press conference, and we're expecting a 25 basis point rate hike. Could that be the turnaround? That would provide some certainty in the market, and the market craves certainty. They want to know what's going to happen next. And with the FOMC meeting, and on the 16th, on Wednesday, when the press release comes out at about 2 o'clock, and about 2:30, when Jerome Powell comes out and gives his press conference and takes questions from reporters, that will provide some sort of clarity and hopefully a roadmap for where we're going next. And that could be a key for this market to finally turn around and we start getting significant green days instead of these lower lows, especially on the Nasdaq, right? Okay, so that's the Nasdaq. The S&P 500, SPX, is the ticker symbol in TradingView to use to look at it. If we look at this, right, what the S&P 500 did today was it broke this key psychological level of 4,200, and we closed at 4,173. That's bad, right? Well, it's not as bad as the February 24th low. That low was 41,114. So 14 versus where we are right now at 73. So we're not at a lower low yet. But be careful of tomorrow, because tomorrow we do get inflation data. We do get an inflation read, and unfortunately, it's going to be a scary headline if the expectation is met at 10%. A double-digit inflationary environment, that would be bad, and that could give us a lower low on the S&P 500. So we need to watch for that. Now, prospects of higher interest rates also kept sentiment negative, as the U.S. Central Bank is expected to raise its target federal fund rate by 25 basis points on Wednesday, the 16th, to try to tame inflation that is a big flame right now. It is nasty. It is messy. It is costly and expensive for consumers, and it's not a good thing. And unfortunately for the Fed, they don't have many tools right now to tame this inflation, as we are also getting a weaker economy. See, when the economy is strong, raising rates doesn't necessarily hurt the economy that much when the economy is strong. But when the economy is weak, like it is right now, raising rates can add further pain to the market. So the Fed is behind it on this one. The Fed is way behind. They should have taken action in December, if not earlier than December, to tame inflation. Now, they really don't have many tools left to tame this inflation while the economy is also contracting and getting weaker. Okay, boy, oh boy, this is something, right? All right, besides the higher borrowing cost associated with rising rates, there is a COVID-19 scare going on in China right now. That added pressure to the markets today, and it strengthened fears of input shortages for tech companies, especially those that have to do with chips. We already have a compounding problem with getting the enough supply of chips, and if China is shutting down a tech hub within the country, that's not a good thing either, and that's not going to help our supply chain mess that we have. Apple was down 2.7% today. Intel dropped 3.1% today. Nvidia, heck, it was down 3.5% today. They all closed in the red because of the scare that's happening in China right now. Now, looking at all of the S&P 500 sectors, information technology dropped 1.9%, and both communication services and consumer discretionary dropped 1.8%. They are the sectors that contain mega cap names, like your Apples, right? And they were among the they were among the bottom of the list. Now, they were right there with energy, The energy sector dropped 2.9% today. A big drop. And if we look at oil on the chart here, let it load for a moment. I'm going to go here and look at crude oil. I looked at this yesterday during our Catalyst Watch live stream, and it was at $106 a barrel. Well, if we look here on the chart, there is this $100 threshold. It is acting as support right now to hold oil up. If we look at this big fall that we had on March the 9th, it was a 12% decline in oil price, specifically crude oil. Now, it bounced at $100.37. And where did it close today? $100.37. That $100 line is a psychological line for investors. Now, it did dip a little lower. It got under $100 a barrel today. It got down to $98.18. But it did close at March 9th's low, $100.37. So we've got a strong area of support that it looks like is building here for oil. Can we get it to stay sub 100? Maybe. It is possible. Now, the financial sector, excuse me, that sector did absolutely good today. So if you were in financials today, you got gains because that sector was up 1.3%. And that followed rates to the top of the leaderboard because rates were going up as well. Now, the healthcare sector was up 0.7%, consumer 0.6%, and industrials up 0.3%. Those sectors posted more modest gains. Now, a handful of stocks within these sectors were responsible for the relative performance of the Dow today. All right. Early on, the market appreciated the decline in oil prices, which, as I just mentioned, briefly fell below $100 a barrel after Russia and Ukraine reported progress in ceasefire negotiations. Well, at least they thought they were making progress. Did Russia stop firing? I don't think they did. And if it was a very small little break. Now, the 2-year yield settled higher by 9 basis points, and this is what helped financials to come up today. It closed at 1.84%. Now, the 10-year, it settled 14 basis points higher to close at 2.14%. It's over 2%. Now, 2%, I've been saying for weeks now, is a very strong resistance area. And we've seen the 10-year kind of balance right there at that 2% point. Sometimes a little below, sometimes a little above. But it is a strong resistance area for the 10-year. Why do you think the financials were up today? It has, with the rates going up, with the 2-year going up and the 10-year going up, that's what raised financials today. That was the biggest reason for why financials were up today. A 14 basis point hike in the 10-year, bringing it over 2%. That is a big deal. And when rates are higher, banks make more money when they are lending because lending costs then for consumers are higher, and the banks are the ones that pocket that extra amount from the interest rates being higher. So that was the main driver for why financials were up today. Now, tomorrow, I'll go back to the S&P 500 because tomorrow could be a different day, right? Every day is a new day. Every day is a different day. But tomorrow, and if we look here on the S&P 500, remember I said the February 24th low was 41.14, and we're at 41.73 right now. If we make a lower low tomorrow that is below the 41.17, 41.14, and maybe even getting below that and cracking into 4,000, 4,900, 4,090, excuse me, that would be a bad sign for the S&P 500. And unfortunately, tomorrow we get another inflation reading, and that will definitely cause ripples in the market with forecast of the producer price index. It reports and indicating headline numbers right now will rise 1% month over month. And this is the big one, 10% year over year. If we truly do get a double-digit inflation reading tomorrow for input costs, this is the producer price index. It's like a sister to the CPI, the consumer price index. But instead of what consumers are paying, this is what businesses are paying. If we get that double-digit read, that 10% year-over-year read, that report will throw another spotlight on the impact of supply chain disruption and, of course, the Russia-Ukraine war. This will have a negative impact on the market with that double-digit headline number. So we have to watch out for that. It could send markets lower in the morning, but we're just one day away then tomorrow from the FOMC meeting conclusion, and we get clarity on rate hikes. That will be a big deal. So we've got two forces fighting each other tomorrow. We've got the producer price index potentially having a 10% year-over-year read in inflation, and day before, potential clarity on rate hikes. So those will be two forces fighting each other. Coin, low per at this level. Your thoughts? All right, let's pull up Coinbase. Ticker symbol is coin, COIN. And let's put it in here. Now, the market volatility in Bitcoin is tied very well with Coinbase here. At least it should be. My theory is that the more volatile Bitcoin is, the more trading there is, volume. The more trading volume there is in cryptocurrency, the better it is for platforms like Coinbase, because every trade, they're getting a fee. Unfortunately, the market hasn't seen it that way yet. And Coinbase right now is making lower lows. Now, I've got to adjust the screen here so we can see this. Or actually, let me just take volume out for just a moment to make it a little easier to see. Now, this is on the daily. So we have a low here on February the 24th, and that low is 162.51. Okay, 162.51. And if we put a marker here and then draw a line to today, we have made a lower low. Now, if we look here on the day of earnings, it started out low, but then closed higher. But that low was 155.92, which was lower than the 162 on February the 24th. So we've got three right here, lower moves, right? And we've got this fourth one right here on January the 28th. It was a low of 162, which again is just about 25 cents lower than the January the 24th low. So we've got four lows here on the chart, and it's making lower lows. Now, do we have a divergence on the top? Can we say that the top is making higher highs? Well, if we put this line across the top here to show you, we are also making lower lows on the top. This again is not a good sign for a falling market or a falling equity like Coinbase. What we want to see is these lows start to line up in a row. if we can make lows that are higher than today's 153.19, and more than just one time, because you can see here in between these low points, you can have little rallies, little bursts, and then you have sell-offs, and then you make another low, again, another little rally, sell-off, and then so forth. Right now, it's not looking good. That would be my take on Coinbase. If you like the company, you believe in it, then wait, because I'm going to put, I know it hasn't been public very long, but I'm going to put the monthly candles here, right? I know it's not very many. Oh, come back here. It hasn't been public that long, but this is, since it has gone public, every month, what has it done? There's a lot of red here, and it is down substantially from this last green high that we had, or green month of October. So if you really like the company, and we can't just time the market and say, okay, this is the low, we can buy here. We don't know when the low is going in. So one thing for especially new investors is to look at the monthly, okay? If we have two green candles together, meaning we have 2 months where we have a green candle in a row, and then we get a third green candle, that would be your signal to buy, because the trend has reversed. Because if we look here, there's only 3 green candles on this entire monthly chart. And again, it hasn't been public long, but I would wait for a green candle, a green monthly candle to form before thinking about buying into this. And as an example of this, I'm going to use the S&P 500 and let this load for just a moment here, because I'm going to go back to the last time that, and I need to fix the chart, the last time that we had a little sell-off, right? And that would be the March of 2020. We had 3 red candles here in a row. January of 2020, February, and then March of 2020. Buying in March, you have no idea where the bottom might end up being. And the bottom was way down here. And if you time that, then awesome. But if not, and you waited for a green monthly candle, you would have bought in maybe somewhere around the 29.18 mark on the S&P 500. And you would have captured a significant rally from here. Oh, I didn't get my tool to work right. But you would have bought in maybe somewhere around here after that green monthly candle had formed, and then you would have ridden to the top, maybe somewhere around the top. Maybe you're still holding, but that would have been a 57% gain. So wait for those monthly candles if you're a new investor. When you're looking at something like Coinbase, which is new, and a lot of people don't understand how the whole mechanics of cryptocurrency works, wait for that green monthly candle, and that will save you from racking up big losses. That would be my take on Coinbase and almost any other speculative play in the tech sector right now. That's what I'd want to see. Because if we look at the Nasdaq again, NDX is the ticker that I use. The Nasdaq is nearly in a bear market right now, almost down 20%. And we don't know where the low is going to finally fall and reach. So waiting for that monthly candle to turn green, that would be your sign. And again, if we go back here to the March 2020, we had 2 February and March lows, red candles. And if you would have waited for that green candle to turn on the monthly chart, you would have racked up major gains and ridden that rally without risking buying in, losing, and then having to wait for the equity or index to bounce back. So instead of trying to time the market, wait for a clear signal. All right, Lululemon, we talked about them yesterday in our Catalyst Watch video, and they had a very, very special line. Let's go back here to the daily, and let's see if that line held today. Let's see. So that line was right here. Okay, got it. I forgot I marked it. So that line was right here at what? $290. And it was down today. It broke that $290 area, but that's okay. For Lululemon, what you'd want to watch for is the February 24th low, and that was a low of $283. As long as Lulu stays above that $283 level and doesn't make another low, then this thing is strong. And I might lean towards the side of the argument that maybe Lululemon, it can stay strong leading into earnings, because we're 2 weeks away from earnings for Lululemon, and that could provide a nice little burst or catalyst for the stock. And maybe it just holds flat and moves sideways until we get there. That's a possibility. But again, that $290 level is a very strong level. Just as long as it doesn't get below the 283 mark and make a new low, then everything is all good and holding strong. So yes, Lululemon looking good as well. It is. That $290 area has been tested through time. And again, like we did yesterday when we looked at this, if we go back and look at the $290 area, it has got so many points of action here in March, February, January, and then we go back here to March of 2021, and then back further, September of 2020, and then June of 2020, June again of 2020, and then May of 2020. So there's lots of reactions along this $290 area, even recently, that shows me that there is strong support at that level, and it could hold there. But again, on February the 24th, it did get down to $283. So we don't want to see it get to that level and then make a new low. Otherwise, it's looking good. And again, it is about 2 weeks away from earnings, so that's good as well. All right, cool. Thank you for the questions. I greatly appreciate it. All right, here's where we stand year to date right now. The Dow Jones, it is still leading, but it is down 9.3% year to date. The S&P 500, it is in correction territory, and that's breaking 10% from your recent high. It's down 12.4% year to date. The Russell 2000 is catching up. Small caps have been making a rebound. It's down 13.5% year to date. And the Nasdaq is almost in bear market territory. It is down 19.6% year to date. And for a bear market, technical here, it is 20% from its recent high. So 19.6%, nearly in a bear market for tech sector, the Nasdaq. All right, let's check in with Bitcoin BTC USD here on TradingView. And I use Coinbase there for the data. All right, so for Bitcoin, and here's a good example on waiting until, green candles, or more importantly, a reversal. And when can we see a reversal? Well, look at Bitcoin, right? Bitcoin was in a big downtrend after reaching its all-time high of 69,000, and it has just been falling. But then we get to this point right here on the chart, the bottom yellow box here. You see these three yellow boxes, the bottom one. Bitcoin got into that bottom yellow box on January the 22nd. And then on January the 23rd, we got a green candle. And then guess what Bitcoin has been doing ever since? Let's make this as big as I can here. Bitcoin, and I'm going to put a line here on this low and go to today. And what has Bitcoin been doing? Bitcoin has been making higher lows. That's the sign that your trend, your downtrend, has finally reversed. So we have this low on January the 22nd, and then we have to go all the way to February the 22nd, a whole month later, where we get our next low, and it's higher. Now, we do have the anomaly of February the 24th. That is a lower low compared to the February 22nd, but it is not a lower low when we go back and look here to the low made on the 22nd, right? The day that it turned around for Bitcoin. So even though this was a big drop and it is below our ascending trend line here, it was not a lower low than what was made on January the 22nd. So that's still fitting our thesis here that Bitcoin has reversed. And then we go here to March the 7th. And again, it's making a higher low. And then we get to today, March the 14th. And again, we have a higher low. So Bitcoin right now is in a confirmed uptrend. It's making higher lows. And that's exactly what we want to see on the S&P 500, especially the Nasdaq, before we go running back in and buying the dips. We want to see these higher lows, all right? And this is a perfect example of the higher low showing that the trend has been reversed. Now, if we go look at Ethereum, ETHUSD, let's see if we can find that trend for Ethereum. Has it broken the downtrend? And if we look at Ethereum here, and I'm going to blow it up again here, and I'm going to put the trend line on it and see if it is the case. We have this low of lows on January the 24th, similar to Bitcoin, and then we draw to today. Let's see. So January the 24th, that was the low. And then we have to go all the way to February the 24th, and it is a low that breaks this trend line, but it is nowhere near the low that was made on January the 24th. So that is a higher low, okay? And then we get to March the 7th. That low is also a higher low in today, higher low as well. So Ethereum and Bitcoin both have reversed their downtrend, and they are both now in confirmed uptrends. That's what we want to see for the S&P 500, the Nasdaq, even the Dow. We want to see higher lows being made to show that the trend has been reversed. All right, your thoughts on Datadog, any support levels? I like Datadog, ticker symbol DDOG. as a company, I definitely think that they have something special, something unique, being a cloud player here in the technology area. Let's get a bigger view here. Okay, I can see an area starting to form here. If we look at Datadog, we've got these lows here, somewhere around the 115 area, give or take a few dollars. Right around $115 a share. I'm going to put a line there to demonstrate what I'm seeing here. So at $115, we have a low here on March, let's see, what is that? I got to go in a little bit closer here to look. Okay, so March the 14th, so today, it put in a low of $113. So just a little bit below that 115 line. And then our low here on January the 24th was 119. So it did make a lower low. And if I tag that to today, it did make a lower low. Okay. So we haven't reversed a trend yet because of that. But what I'm looking at is I'm looking for reactions on this 115 line, and I'm seeing several. Here on August the 4th, 2021, there is resistance at 115. We get over here to February of 2021, and again, we have a top, a resistance right around $115. And then we go back a little bit further to October of 2020, and again, it's right around that $115 area. We have resistance there building. So we have a lot of reactions, and this is similar to Lululemon. We have a lot of reactions around a specific price point. So that price point then becomes psychological, especially for traders. Now, the one downside here is the fact that we made a lower low today. That's what we have to watch for. Even though it looks like there's a lot of reactions around, give or take a few dollars on both sides, there's a lot of reactions around $115 a share. It doesn't necessarily mean that it can hold that area. It is a strong area, and it can hold a lot of pressure, whether it's supporting pressure or resisting pressure. It can hold a lot of pressure at that $115 a share area, but do be careful because we made a lower low here. Now, if we look at the closing, of course, this low on January the 24th, it closed higher that day by 8%. So we're not looking there at the close. We're looking at the low that was made, for that day, the very, very bottom. So that's my only concern here with Datadog, is that it did make a lower low today. However, it does have strong support or even resistance, but it has strong pressure at $115 a share. So that's the two things there for Datadog technically on the chart. Now, fundamentally, I think it's a great company. And I think this would be a company definitely to have on your shopping list for whenever a reversal is confirmed, or you feel comfortable or confident enough knowing that, you know what, maybe this is the low, so I'm going to go ahead and throw some shares in and get some. So when it's making these new lows, this is another theory or thought to investing. When it's making these spectacular lows, that's when you go in and buy a couple shares. And you can dollar cost average, and I know dollar cost average doesn't work for every situation, but it is a good general rule to have in your list of rules that you follow as an investor. So when it does make these, lower lows, maybe you want to consider to, grab a couple shares at those lows, but you never know when the low is going to be. So maybe it's just better to wait for the trend to be confirmed and in reverse. So uh, a good entry point for, all right. Let's look. The hotel industry is definitely a struggling one. And this is, when you look at this chart, this is a tough one because this thing swings so wildly. And it has definitely, over the past couple years, been a headline running stock. But if we want to look for an area that has a lot of reactions on it, we're probably looking somewhere around the 148, $145 area. And if we look at the March 8th low here, that was $146.07 a share. So if you're looking for an entry point here, I'd probably be looking for sub $150. When it breaks that $150 a share, gets into the 148s, 146, 144, that looks like a safe area that has held up well, at least going all the way back to September of 2021. That's been a pretty good area of support and a turnaround. And if we go prior to September of 2021, it was a good area of resistance. Several markers there. So if I had to pick something, I'd say sub 150 for Marriott there. Ticker symbol MAR. All right. I did want to talk about a value stock that's holding up really well, and that's Builders First Source. The ticker symbol is BLDR. And when you look at the chart here, you'll see what I'm talking about. It's making higher highs. And if we go here and look a little bit closer, it had earnings back here on March the 1st. But if we look at this low that was made here on January the 28th, when we go look at February the 24th, it is a higher low. We look at March the 7th, a higher low. We look at even today, March 14th, even though it was down 5.8%, it is a higher low. And we have a wedge pattern starting to form here, which could lead to a breakout to the upside. Now, with Builders First Source, why are they a value stock? And why are they performing so well? I mean, if we go back here and look, they had this one decline right here, starting on January the 5th, almost just a couple days after the market started the new year. It did have this sell-off down to this support area around $65 a share. It had that one sell-off. And if we go back and look, there's a couple of times that it's moved sideways, particularly here, May 2021 through July of 2021. It moved sideways, maybe slightly down, bouncing off its 200-day simple moving average there. And if we go back further, we've got to go back to March of 2020 to, find a real, another really fall off and sell off for it. So it's been doing really well. Now, if you are a member, this would have been during November when we first mentioned Builders First Source. So back here, right around this earnings report here, that's when we first would have mentioned Builders First Source. And getting in on that one, you'd be in the green right now. holding that. But let's talk about this company here for a little bit. Why is it a value stock? Why is it holding up so well? So as inflation accelerated to 7.9% in February, yeah, almost 8%. I wanted to highlight a company, and this is why I'm talking about Builders First Source, that has had successfully passed most of its rising costs along to its consumers. And it's done a great job at that. Now, this is a stock, like I said, that was put on our value stocks list. So if you're a member, you get access to it. If you want to become a member, click the first link in the description or the link in the live chat. We update these constantly. Now, it has continued to expand its adjusted EBITDA margins year over year in each of the last 5 quarters. Most recently, seeing an increase of 700 basis points to 17.1% in Q4. Meanwhile, though, Builders First Source trades at a relative attractive valuation of 7.9 times forward earnings and is aggressively buying back its stock, which makes it a good candidate for a value stock because it's buying back stock, it's at a good valuation, and it's holding up to inflation pressures. So the company repurchased $2 billion of its shares in 2021, and it has announced its intent to buy back another $1 billion, $1 billion going forward in 2022. Now, that $3 billion there, that's over 20% of the company's total shares outstanding. That's pretty aggressive. Now, Builders First Source is the US's largest provider of structural building products, also value-added components and residential construction, repair, remodeling, those types of services as well. Now, by manufacturing floor and roof pieces, walls, panels, stairs, doors, and windows. So all the components that are vital in building a home and also remodeling a home give it, Builders First Source, a relatively inelastic, meaning that it can hold its price very firmly because the products are needed more so than what people don't care what the cost is, right? They need these products to build homes no matter the cost. So that's what gives it some intrinsic value. Now, the company can more easily raise its prices without taking a significant hit to its revenue because, again, these are what home builders, remodelers need to build and remodel homes. Now, this advantage was blatantly clear in Builders First Source earnings report over the past year. By more than doubling adjusted EPS year over year to $2.78 in Q4, blowing the roof off of estimates, Builders First Source kept the streak alive, having not missed analyst earnings expectations for over 5 years. So it's a pretty sturdy and strong company itself. Now, another thing that I would add here is revenue growth has also been outstanding over the past year, never seeing sub 40% growth year over year. In Q4, revenue soared by 83%, despite lapping a period of 45.7% growth the year prior. Although these massive growth rates can make it difficult to compare, Builders First Source laid out impressive long-term financial targets in early December. Builders First Source expects a 30% or more compound annual growth rate in adjusted EPS and over 10% annual growth in net sales through fiscal year 25, using fiscal year 21 as the base year for its pricing projections. Now, This would translate to adjusted earnings of $12.40 per share and revenue of $23.1 billion in fiscal year 25. Now, following a tremendous fiscal year 21 in which Builders FirstSource reached $10.32 in adjusted EPS and $19.9 billion in sales, these goals seem way more conservative than maybe previously thought. Now, the company is building in what I would say normalization of commodity prices over the long term. Also, these long-term metrics display secular tailwinds in the home building industry, like the shift from the city to the suburbs and younger generations reaching their home buying years. Those are important. Now, unlike home builders like KB Homes or Lennar, which does report earnings later on this week, and Toll Brothers, which are your big three, they have to reduce new orders to work down their backlogs and find economically beneficial areas to build communities. And of course, deal with permitting and coding from the cities and counties they're working in, which can lead to delays. Builders FirstSource just supplies the materials. It doesn't have to deal with all those other headaches like the home builders do. So I would say Builders FirstSource is a better source to buy shares in the housing market than any of the home builders. Now, its business reduces the number of disruptions that it has to deal with in relative to the home builders, like I just said. Now, moreover, Builders FirstSource also gains from the home repair and remodeling industries, which reports from Home Depot and Lowe's have shown are not cooling off. Overall, as inflation adds to the uncertainty in the markets, Builders FirstSource has provided transparency in its long-term growth, helping to provide some level of certainty going forward. And certainty is what the market craves. Also, with interest rates set to rise in this year, starting maybe on Wednesday, high multiple stocks have fallen out of favor. By trading at just 7.9 times forward earnings, Builders FirstSource's downside is relatively limited. Speaking of interest rates, home builders have commented over the past several months during their earnings calls that even as mortgage rates have already gone up, they have not witnessed a reduction in demand. Bottom line, I like Builders FirstSource as an excellent value stock, given its valuation combined with its aggressive buybacks. Also, the operating in the home buying remodeling markets, Builders FirstSource is positioned to benefit from strong secular tailwinds. So what do you think about Builders FirstSource as a value stock in the home sector? Let me know in the comments below. Okay, Enphase, I see your comment there. Support levels at 140. Let's go look at this awesome company. ENPH is the ticker symbol. And also, let me know what you think about Builders FirstSource. Do you think it is a good value stock? All right, something that caught my eye immediately here with Enphase is these lows. So we have a low here on January the 24th, and then we have this low right here on February the 24th, a month later. And then if we go from that one to today, that is 3. Yep, no, that's not 3. That's 4. We have January the 28th here. That is 4 higher lows. 4 higher lows. That could show a reversal in the trend, that big downtrend that it has had. Now, something else to keep in mind when it comes to Enphase, it's alternative energy. Right now, with oil prices up, that made Enphase a spectacular company that people were looking to buy. Now that oil prices have come down some, that's why you see Enphase down 7.8% today. It right now has got a soft correlation to oil prices. And if oil prices go up, so do the shares of Enphase. When oil prices come down, so do the shares of Enphase. There is a soft correlation right in this moment in time with oil prices and alternative energy. So that's the big thing you have to watch. Now, Enphase has got a top here right around $182 that was set on February the 9th. So I'm going to put a line here from February the 9th over to this high here on March the 11th. And what do we have? We have a higher high. Now, this first high on February the 9th, $183.15. And then we have another high here, but it wasn't as high, 182. So just about $1 less, more like 75 cents less. But the high hit on March 11th was 186.38 versus 183. So we have a higher high here. That is a good sign. And we have 4 higher lows. That is also a good sign. Just keep in mind, though, that this little rally right here that we've had over the past month or so with Enphase has been softly correlated with the rise in oil prices. Now, if we're looking for an area to get in, and we know that Enphase, if oil comes down, Enphase may come down too. I'd probably want to get in sub $130 a share. So anything under that, I think, is a good deal. Okay. Now, it is still, even at $130 a share, it is still a relatively expensive stock. And that's because a lot of investors piled into this early and made the price go up substantially. However, if we look here over the long term for this stock, going back to the highs that it hit back in January of 2021, we can see the movements here of this stock. And if we kind of maybe try to, let's see here. The lows of this thing are really, really at $115 a share. So if we go back to January the 27th, 26th, it was down to $115 a share. And then we go back to May 2021. It's also hovering around there. November 2020 and October 2020. So it looks like it's got really strong support around $115 a share. So here would be my entry point here for Enphase. Sub 130 to 115. If you're getting in that $15 range right there, I think you're getting into a fabulous company. The fundamentals for Enphase have only gotten better. They've only gotten better. And while the stock has basically been moving sideways for a year, sure, it did make a new high back in November of 21. But with these ups and downs, these rallies and sell-offs, it's basically been moving sideways. So sub 150 is good, but 130 to $115 a share, that's where I would really want to get in on Enphase and have. I do own Enphase, and I love the company. So that's your question for Enphase. All right, that's everything that I wanted to talk about today. But if you do have any other questions, let me know. I'd be happy to answer them. I'll give you a minute or so here if you want to ask another question. Otherwise, we'll wrap up today's live stream. I do have videos on Tesla, on a firm scheduled to come out within the next 24 hours. So watch for those videos. Tesla, we're talking about the increased demand in EVs and what that is doing to a supply chain that is already fragile. And then a firm, it just got hit again. There's another problem with a firm that has just popped up. So I'm going to talk about that in the video on a firm. So watch for Tesla and a firm videos coming out in the next 24 hours. And if that's it for today, then we'll wrap it up here. And I will see you tomorrow for our live stream at 5:30 p.m. Eastern. And we do it every day the market is open. Mainly to answer your questions. So if you are watching the replay of this, do leave a ticker symbol and question in the comments. We'll talk about it during tomorrow's live stream. And if you could, please, for the work that we do here, smash that like button, share this video, and click the first link in the description to beat the market with us. All right, ladies and gentlemen, thank you so very much for joining me today. I greatly appreciate it, and I'll see you in the next video.